Netflix has fallen more than 30% from its mid-2025 highs, tumbling from over $130 to around $80 to $90 in early 2026. The culprit? The market is punishing the streaming giant for its ambitious move to acquire Warner Bros. Discovery in an $82.7 billion deal, sparking fears over debt, dilution, and regulatory hurdles. Let's start with the bull case, why Netflix could be a buy the dip opportunity. First, the stock is more reasonably valued after this pullback, with the PE ratio compressing to levels that may appeal to long-term investors. Second, Netflix's advertising business is booming, expected to double in revenue in 2026, providing a high-margin revenue stream that offsets slowing subscriber growth. Third, the Warner Bros. Acquisition, if it goes through, would add a world-class content library, reinforcing Netflix's competitive edge in streaming. And finally, the core business remains highly profitable, with operating margins near 30% in 2025, proving Netflix is still a cash flow machine. Now, the bear case. Why caution is warranted. The Warner Bros. Deal carries enormous risk, with $80 billion in potential debt and dilution threatening shareholder value. The Department of Justice is reviewing potential antitrust issues, which could block or delay the acquisition and leave Netflix paying massive fees. Meanwhile, the streaming business is showing signs of decelerating growth, and recent insider selling has further fueled negative sentiment. Short-term investors could face high volatility and dead money if these risks materialize. So what's the verdict? For long-term investors betting 3 to 5 years ahead, Netflix's content dominance and growing ad revenue make a compelling bull case. But in the next 6 to 12 months, the bear case dominates, with uncertainty, regulatory scrutiny, and debt risk creating a choppy trading environment. The question for you is, are you ready to ride out the storm, or is Netflix too risky right now?